In this section, we're going to discuss corporate liquidating distributions. So a liquidation, of course, means we are going out of business. Our corporation is disbanding. It may not be performing as we would like. We may have shareholders. If it's a closely held corporation, we may have shareholders who want to retire. But for whatever reason, we're liquidating all assets and going out of business. In this chapter, we're going to talk about the consequences of that, both to the shareholder and the corporation. And one thing we need to remember is the order of distribution. So thinking back to when you had maybe a business law course, remember a corporation is owned by shareholders, and shareholders are what we call the residual owners of a corporation, meaning they get last in the order of distribution. They are very last. So they get everything that's left over, which can be good or bad. They can get, a lot if the corporation was profitable, or they can get not much. So when a corporation is going to liquidate, first they have to pay off all their creditors. They either pay them off with cash, or they have to sell their assets in liquidation and pay off their creditors. After that, the shareholders are next in line. And a lot of that, or all of that really, all the tax consequences are going to be based on the shareholders' basis in their corporate shares. And remember back to Chapter 2, I believe, when we talked about forming a corporation in Section 351, most corporations are really cheap to form because Section 351 applies and there are no tax consequences upon formation. But the flip side of that is that our shareholders take essentially a transferred basis in their shares. So if they have contributed appreciated assets, their shareholder basis in their shares is pretty low. So you often hear people say corporations are cheap to form but very expensive to disband. Because when we sell everything and liquidate, our gain is going to be based on that low basis. So we're going to have usually a high gain upon liquidation. For Section 332 to apply, it has to be a complete liquidation. And the Treasury Regulation 1.332-2C defines what that means. To constitute a distribution in complete liquidation within the meaning of Section 332, the distribution must be made by the liquidating corporation in complete cancellation or redemption of all of its stock in accordance with a plan of liquidation, or one of a series of distributions in complete cancellation or redemption of all of its stock in accordance with a plan of liquidation. If there's more than one distribution, they all must be part of the liquidation plan before the first distribution is made. Okay, so in 1, it says this distribution is a complete liquidation and cancellation of all the stock. Provision 2 provides that sometimes we can't make all of those distributions at once. We can have a series of distributions, and that is okay. That still qualifies under 332 as a plan of complete liquidation, so long as each distribution is part of a plan from distribution 1 through the last one. They're all part of the same coordinated plan of liquidation. Liquidation is complete when the liquidating corporation and the receiver or trustees in liquidation are finally divested of all the property of the corporation. A status of liquidation exists when the corporation ceases to be a going concern. So it ceases to be in the business it was previously in, and its activities are merely for the purposes of winding up its affairs, paying its debts, and distributing any remaining balance to its shareholders. The liquidation may be completed prior to the actual dissolution of the liquidating corporation. Okay, so dissolution is a state thing. I file an article of dissolution with the Secretary of State of whichever state in which I am incorporated. And the tax liquidation and the state dissolution don't have to coordinate. The dissolution does not have to happen before a complete liquidation can occur. So first we're going to talk about shareholders and the tax consequences to shareholders who receive assets in liquidation. All right, so basically we treat this like a sale of stock at fair market value. That's basically how this is treated. So the amount, timing, and character of gain or loss, the general rule is we usually have capital gain because usually the stock is a capital asset in the hands of the shareholder. And we measure that gain by the money plus the fair market value of all property received minus the adjusted basis of the stock. This is just like we measure the gain on the sale of any asset. This is no different. And in the liquidation of the corporation, I can take gain and loss. The only limitation on loss generally on the shareholder side is I usually can't claim it until the tax year in which the final distribution is received. So if this liquidation includes a series of distributions and they span multiple tax years, I can't recognize that loss until the last distribution is received. The adjusted basis of each property received to me, so if the corporation is distributing assets instead of just cash in liquidation, and I get some of those assets, my adjusted basis in those assets is the fair market value on the date of liquidation. Again, that makes sense because we treated this as a sale. I sold my stock, and in return, I received assets. So I get to take a fair market value basis in those assets because that's the value I use to compute my gain or loss. The holding period of those assets in my hands generally begins the day after the liquidation date. And the tax treatment is going to vary if the control rules apply. So we have Section 267 control rules and ownership rules, and that would vary the tax treatment a little bit, and we'll touch on that later. Okay, Section 331A provides that distributions in complete liquidation are treated as exchanges, and the amounts received by a shareholder in a distribution in complete liquidation of a corporation shall be treated as in full payment in exchange for the stock. So this is basically what we said before. The amount received is treated as full payment for the stock, and the gain or loss is the amount realized minus the adjusted basis. The amount realized is going to be reduced by any liabilities assumed or acquired. If I get an asset and it is subject to a liability and I assume that liability, that's going to reduce my amount realized. And like I said, generally the gain or loss is going to be capital because the stock asset, is a capital asset in my hands. Section 1244 changes the general rule of treating the gains and losses as capital gains and losses in the event of small business stock that's sold at a loss. So thinking back to 1244, we covered it in a previous chapter. If you are a single person and you own Section 1244 small business stock, you can treat up to $50,000 of losses from that stock as an ordinary loss, which we like because remember, ordinary losses can be deducted against ordinary income, whereas capital losses can only be deducted against capital income. And as a individual shareholder, you could only deduct up to $3,000 of capital lost against ordinary income. So again, we like this provision. The limit is $50,000 of loss for a single taxpayer and up to $100,000 of loss if you are a married filing jointly taxpayer. All right, also, corporate shareholders holding worthless stock in a subsidiary can also treat that loss as ordinary. Accrual basis shareholders will recognize the gain or loss when the all events test has been satisfied, and a cash basis shareholder will recognize that gain or loss when there's actual or constructive receipt of the assets. If the shares were purchased at different times or for different amounts, we're going to have to compute gain or loss on each share or block of shares because they will be different. Okay, let's look at problem 32. For 7 years, Monaco Corporation has been owned entirely by Stacy and Monique, who are husband and wife. Stacy and Monique have a $165,000 basis in their jointly owned Monaco stock. The Monaco stock is Section 1244 stock. They received the following assets in liquidation of their corporation: accounts receivable of $25,000, a car, office furniture, and $5,000 cash. A, what are the amount and character of their gain or loss? Okay, so this is generally pretty simple, right? They sold stock and they sold it for cash plus these assets. We're going to value these assets at their fair market value in determining the amount received. And then we're going to subtract their adjusted basis. All right, so in part A, you can see that the amount received is the fair market value of all those assets plus $5,000 cash. So it adds up to $52,000. And then we compare that with their adjusted basis, which was $165,000. So we have $113,000 recognized loss. We treat $100,000 of that as ordinary under Section 1244 because it's qualified small business stock. And these people are married, so they get $100,000. The rest is going to be a long-term capital loss. Remember, we like ordinary losses because we can deduct all of it against ordinary income. If it was only a capital loss and we had no capital gains to offset it, as an individual, they could only deduct $3,000 against ordinary loss. All right, Part B, how would your answer change if the accounts receivable instead has a $140,000 fair market value? Okay, so now the amount that we receive is going to be $140,000 of accounts receivable, $16,000 of car, $6,000 of furniture, and $5,000 cash. So the amount received is a total value of $167,000. I subtract my adjusted basis of $165 and I get a $2,000 long-term capital gain. Part C, what is the Monaco's basis for each property received in the liquidation in Parts A and Part B? Okay, so it doesn't say it in here, but I'm assuming that Stacy and Monique's last name is Monaco. What they want to know is the basis that Stacy and Monique take in these assets that they received. So what basis do they take in the car, the accounts receivable, and the office furniture? And of course, the answer is they take a fair market value adjusted basis. None of these were subject to liabilities, so we just take a fair market value adjusted basis. So in Part A, that's the accounts receivable of $25,000, car at $16,000, furniture at $6,000, and cash at $5,000. In Part B, it's exactly the same, except the accounts receivable, remember, now had a fair market value of $140,000. So the answer to Part C is they take a fair market value basis in their assets received in liquidation. And number 30, parent corporation, which operates an electric utility, created a 100% owned corporation subsidiary that built and managed an office building. Assume the two corporations have filed separate tax returns for a number of years. The utility occupied 2 floors of the office building, and subsidiary offered the other 10 floors for lease. Only 25% of the total rental space was leased because of the high crime rate in the area surrounding the building. Rental income was insufficient to cover the mortgage payments, and subsidiary filed for bankruptcy because of the poor prospects. Subsidiary's assets were taken over by the mortgage lender. Parent lost its entire $500,000 investment. Another $100,000 of debts remained unpaid for the general creditors, which included a $35,000 account payable to parent at the time sub was liquidated. What tax issues should parent and subsidiary consider with respect to the bankruptcy and the liquidation of subsidiary? All right, so they should consider these issues. Some of these aren't as important to us because we haven't talked about them, but most of them are. What gain or loss does parent recognize on the transfer of its remaining property to the mortgage lender? All right, so remember we talked about 1244 stock, and then we also talked about Section 165 and how it provides that if a parent has shares in a subsidiary and they become worthless, Section 165 allows that parent to treat the shares in the investment in the worthless subsidiary as an ordinary loss. All right, so that whole $500,000 can be an ordinary loss. Does subsidiary have to recognize cancellation of debt income from not having repaid its debts? Okay, so remember, there was a $35,000 debt, a $35,000 account payable to parent. So the sub owed $35,000 to parent. And generally when our debts are canceled, that's income to us. It's gross income. But there is an exception when you're insolvent. And remember, insolvent means you can't pay your bills. So the subsidiary is insolvent here. So generally the sub would not have to recognize income on that unless the forgiveness would make them solvent. But here that doesn't appear to be the case. We're not going to worry so much about bullet 3. Bullet 4, can subsidiary deduct the liquidation expenses on its final return? Yes, it can. What is the amount and character of the loss parent recognizes upon surrendering its subsidiary stock and then upon not being repaid for the open account debt? So we talked about the loss. They can take an ordinary loss for their investment. The unpaid amount of the accounts payable can be deducted as a bad debt by the parent. And what happens to the subsidiaries' tax attributes? We'll talk about that in the rest of this chapter, but they go away, they disappear, and we'll talk about why that is later.